In this video, I'll be going through some of the problems at the end of Chapter 13. I'll look first at number 37, and of course feel free to stop and replay any of these videos as we go, in case you want to review some of the concepts or review some of the calculations. So number 37, found on the top of page 1341, we have three investors who each invested $30,000. Amount borrowed was $200,000. The amount borrowed of $200,000 was secured by the building, and so there was no personal recourse against the partners. However, this is qualified non-recourse debt, so we do include it in the at-risk amount. All right, so the question is, how much is each partner's at-risk amount? Well, in this case, I just took the sum of the total invested, $90,000, by all three partners, 30 each times 3, and to that I added the amount borrowed of $200,000, since that's included at risk because it's qualified non-recourse debt, and then I divided by 3 to get each partner's share. So we have the the 90,000 plus the 200,000, which is 290,000 divided by 3, and that gives 96,667. That's the at-risk amount. So this is again at-risk, means it's the amount they have at stake, and it's used in part to determine whether future passive losses are deductible. Number 38. Joshua worked 1,300 hours as a tax consultant, 450 as a real estate agent. His one employee, his wife, worked 300 hours in the real estate business. Joshua earned $50,000 as a tax consultant, and together the couple lost $20,000 in the real estate business. So here we have a passive loss. How should Joshua treat the loss on his federal income tax return? Well, we need to determine whether he is a material participant. Because if he's a material participant, then the activity is passive, and it would be subject to these passive loss rules we've been discussing. However, it turns out that Joshua does pass test number 3, listed in the text. And test number 3, which is listed at the top of page 1310, if you're following along, says that the individual participates in the activity for more than 100 hours during the tax year, and the individual's participation is not less than any other individual. Well, in this case, he worked the 450, which was more than his wife's. Therefore, he passes test 3, and this is not a passive business. This is an active income business. Therefore, any losses from this active business are deductible against other income, and therefore not subject to the passive activity loss rules. Number 39 is brief, but I wanted just to mention it, where Donald has 2 investments that are considered non-rental passive activities, and talks about when he acquired these activities. His share of the loss from activity A in the current year is $15,000, and his share of the loss of activity B is $4,000. What is the total amount of Donald's suspended losses? Well, suspended losses means he cannot use these losses to offset any passive gains this year. Why is that? Well, because he has no passive gains. He only has passive losses. Therefore, even if he did pass the at-risk rules, which are the first rules we would normally look at, he would not have passed the PAL, or passive loss rule, activity loss rules, because there was nothing to net against the loss against this year. So they're suspended, and these losses of $19,000, this loss rather, can be carried forward indefinitely to offset future passive gains. In the next video, we'll demonstrate additional Chapter 13 problems.